Today, that stress conundrum. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, as you may know, every month I model financial stress amongst households in Australia based on our surveys. And I normally provide that information in our live show. In fact, it was last Tuesday. But I've had a number of people ask for more information about our stress series. And so what I'm going to do today is go through those results once again, but also just put a bit more context into it. And at the end, draw some broader conclusions. What amazes me is how many people, particularly on Twitter, react very negatively whenever I talk about stress, claiming that it's completely disconnected from reality. To which I would reply, no, people who say that are in fact disconnected from reality, because what I'm doing is looking at how households are actually dealing with their finances. And as I'll explain shortly, there is a particular mechanism that I use, money in, money out, to be able to define people as stressed or not. There's a broader point here too as well, and that is that a lot of people are in denial about how many households are under financial pressure, despite the fact that it is clear from other people's surveys that around 30% of households cannot find 1 month's free cash flow at the moment, that many people are under the pump with regards to their mortgage payments even now, and with interest rates potentially going to rise while incomes rising more slowly, we can hypothesize that things only get worse rather than better. So this to me is a very important forward indicator of what is likely to play out in the economy for this reason. If households are highly committed to making their mortgage repayments, as they are, and in some cases up to 60% of their income is actually going directly to support mortgages now, particularly in Sydney, and in a slightly lesser extent in Melbourne, it means that they have much less money available to spend elsewhere. So there is an interesting and direct correlation between broader economic activity and mortgage stress. The higher stress goes, the less activity there is in the economy. Therefore, this series that I create is actually a very important forward indicator for future trajectory of the economy. There is also some correlation with defaults later, but of course, with property prices having risen so fast in recent times, in some areas and in some types of properties, many people can still sell and get out with their shirt if they need to. And I would make the point that we're seeing a very considerable lift in the number of new listings coming on. But if you look carefully, quite a few of those are actually property investors who are deciding to sell, or owner-occupiers who are being forced to sell because they are unable to meet their mortgage commitments. Now, what I'm going to do is to play the segment from the live stream show now. The first element describes the way the model works, and the second element describes the information that we actually showed last Tuesday. So if you watched the live show already, you're now dismissed. I run surveys. Those surveys feed into my core market model, and that core market model then determines a lot of the modelling that I do subsequent. And with that view, we can slice and dice the data all sorts of different ways, and we can also then put it into our scenarios and talk about what the implications may be. So I will talk about scenarios a little later on as well. And those scenarios are based on mortgage stress data, the price trajectory data, the buying and selling intentions, the migration data, CPI, other economic data, into the core market model through our different scenarios. And that allows us then to look at information down to a postcode level or whatever. And we also do, of course, have these conversations one-on-one with people if they'd like to go into a deep dive on around a particular suburb. We're still running them. We've got quite a lot of people in the pipeline. It's not financial advice, but it is quite detailed information about a particular suburb or postcode. and we can talk about some of the stress, some of the trends, and even some views as to where pricing may go. It's just an opinion, it may change, but that's something which people quite value, I think, in the current environment. Very uncertain, of course, at the moment. And you can also book up to an hour's time to converse with me about that, and also issues surrounding it. There is a fee involved if you're interested in signing up, and to contact me via the DFA blog. We're booking about 3 to 5 weeks out at the moment. So when we talk about mortgage stress, it's very important to understand what we're talking about. This is based on my modelling, as I said earlier on, and we're looking at cash flow, money in, money out. We're looking at how households are coping with all their commitments and all the money coming into the household from all sources. So if they're underwater in terms of cash flow, they're classified as stress. That doesn't mean that they're going to default tomorrow, but what it does mean is that they're going to have to pull down on their savings, or pull down on credit cards, or get more loans, or pull down on equity to keep going. And if they keep doing the same, eventually the equity diminishes and the financial situation that people get into deteriorates. And over the medium term, unless they change their behaviour, financial stress follows. That leads ultimately to them having to sell the property, all those sorts of things. And we have a definition for rental stress as well, where people are handling rents rather than paying mortgages. Similar philosophy. We also have an investor stress definition, which is a bit different, because there we're taking into account negative yields in net terms on the property, or trying to sell it and not being able to sell it, or trying to let it and not being able to let it. All of those factors in there. And then we have an overall financial stress, which is an aggregate measure of the total for the whole household for each postcode. So that's how we do it. And there's a lot of shenanigans on Twitter recently about the stress and how it's done, and the media pick it up quite often, particularly now, by the way. I expect to see some more press coverage in the next few days. But people can't get their head around what I'm doing. I'm doing it differently. It's not defaults, okay? It's not the same as the way that banks measure the 90-day default rates. That's also a model, but it's a different number. This is a different measure. But it's a very important leading indicator, and it shows you quite a lot about what's going on. So that, with that introduction, let me then show you the overall trend. So this is the mortgage stress for October. It's come back just a little. So basically, we were at 42 and a bit. We're now at 41 and a bit since last month. And that's partly because a few more people have come back to work. More people have been able to refinance their mortgages to a lower rate. And because more people are actually now also receiving, or were receiving, some government payments because of COVID, that also helps a little bit. Of course, some of that will unwind now. But this is the other interesting point. The household debt ratio. So this is the total debt ratio. That includes SMEs, it includes all businesses and all households, is at 183.8. Significant spike up. So again, you're seeing in the underlying data, credit is continuing, and the debt to ratio between the credit and the household income is high again. So that indicates more pressure. What I can then do is look at the real data. This is the previous one, and then we'll jump to the October data. And what I've done is I've highlighted in yellow where things have gone up. So if you look at the ACT, in fact, all of the stress metrics deteriorated in the ACT over the last month. That's a function probably of the lockdown more than anything else. And it's still lower than some other states, but it's quite significant. So about half of households are in some difficulty. In fact, that 50% metric is quite a lot higher than some other states. So that's something to bear in mind. And of course, it's interesting because people always think of the ACT as a really wealthy sort of sector of the economy, but under the waterline, there are some financial issues. If you look at New South Wales, there was a little bit of improvement. That's partly to do with some of the unlocking. It's partly to do with some of the other factors that I mentioned earlier on. NT's deteriorated. Queensland's deteriorated. South Australia's a bit up and down. Mortgage stress higher. Rental stress a little lower. Investor stress not so strong. Tasmania, significant rise again. I keep looking at Tasmania thinking, how much worse is it going to get? Because the Tasmanian economy is meant to be the best, most buoyant, according to CBA, but there are a lot of people really under pressure. Victoria, down a little, but still very high, 43% of households in mortgage stress, just behind the NT at 44%. And then WA, a slight improvement, down to 41%. So the overall is 41.4% for mortgage stress, 40% for rental stress, 25.6% for investor stress, and the overall financial stress metric is 39%. So that's pretty high, and that's really just highlighting that the whole question of what's going on is not really being fully understood by many of the politicians, or maybe they prefer to look away. Households, a lot of households are in a bind at the moment. They've got pressures, and some of those pressures are coming from higher cost of living. Fuel costs, of course, have risen. The real CPI number is a lot higher than the one that is officially forecast, of course. Real incomes have not happened. Growth has not happened at all. A lot of people have also lost hours. They've had some small support from governments in some cases, but even so, it's pretty difficult. So the question now from here will be whether, in fact, the mortgage stress starts to ease down. But then, of course, now we've got this sequence of higher rents probably down the track. Now, we can also look at this by segment. I'm not going to go through this in detail because it's not a hugely different story, but it's worth highlighting that young growing families, including first-time buyers, 75% of them are under difficulty. A lot of people have got very big mortgages up to their gills in mortgage, and their incomes are not necessarily keeping track with it. So that's a pretty worrying number. And then we've got the battling urban and the disadvantaged fringe, both of whom have significant issues. We also have, of course, other segments. Young growing families, I've mentioned, they're the ones at the top. But even young affluents, some of them are not doing that well. Quite a small number with mortgage stress, but if you look at the rental stress, a lot of those are actually struggling. So a lot of them have got investment properties that are not performing. A lot of those investment properties are high-rise properties, and they're either vacant or they're actually having to give away lower, cheaper tenancies. And if you look at the investment perspective, it's translated through. So investors are finding that they have to actually forego some income simply because of the fact that there's a high proportion of people who are actually struggling. And I'll just highlight also that our exclusive professionals, those more affluent, right at the top of the market, some of those are also highly leveraged. They've got multiple properties, they've got investment properties, they've got a lot of assets, of course, which they can probably unwind, but in cash flow terms, they're finding it quite difficult too. So wherever you look, you can see the patchwork quilt effect. And then they're just going through this quickly in terms of the locations. This has become clearer and clearer now as things progress. So if you look at the top postcodes, Victoria, Narre Warren, Victoria, Berwick and Harkaway, Hoppers Crossing, Clarkson, Towner Park, Western Australia, Sydenham. So it goes on. So the first 4 or 5 there, you'd all say all of those are high growth, high development areas where they've still been building and are still building quite a lot of new properties. A lot of new people have come into the area. So the high growth areas are where the highest number, and this is on number, not percentage, highest number of households in difficulty. So that's partly a function of the fact there are a lot of households there with a lot of big footprints in terms of just count, but also a lot of highly leveraged people. As you go down the list, you can pretty much see some of the flavours. We also got some regional areas like Ballarat, Tamworth. They're still also feeling the pain as well. Unfortunately, we're seeing it getting just more and more ground in. Now, if we then look at the rental stress, it's a bit different. Some different areas. Some of the regional areas are finding it difficult, like up mid-north coast, central coast, I should say, West Gosford. Then we've got Greystanes and Bondi Beach. A lot of those are actually, the Bondi Beach ones are the old high-rise, which rents are actually, a lot of people are finding it quite difficult to get rents paid there at the moment, which is no surprise from what I'm seeing. Wollongong's on the list, Surrey Hills, and then we go up to Queensland and, Labrador, places like that. So some of the rental properties up in Queensland because they've been able to put the rents up, is definitely creating an issue too. And you can see there that some of those have significant numbers of households. And then if we quickly look through to investor stress, a little bit different, but Westmead, places like that, up on the Queensland coast, Mandurah, St Kilda, and then so it goes on, other areas in Queensland. It's quite interesting how a number of Queensland areas are actually struggling. Now, fascinating, of course, because the rental returns are meant to be better in Queensland, but we're also seeing now more of them finding it hard to get the rents they need. And then we've got places like Lane Cove and Surrey Hill, and then ACT, and then DY, and on it goes. So that gives you a bit of a flavour as to some of the hotspots. And I will just show you the financial stress one, because that's the aggregate measure. So this is the total financial stress data. And you can see there, well, some of the similar ones: Narrawarren, Cranbourne, South Tamworth, Blacktown, Belbridge Park, Ballarat, Little Mountain. Some similar stories there with regards to the high growth corridors, some regional areas. So it's a complex patchwork. And one of the things I keep saying to people is, don't just take it up to a high level and sort of try to aggregate. You've got to go down into granularity here to see what's really going on. Okay, let me now then turn to the stress mapping, because that's something else that we can definitely chat about. And to do that, I'm just going to switch across to here. So this is my mapping tool now. And what I've done here is I've started with Sydney. I'm showing the percentage distribution. This is actually in percentages, so the 7% or below up to 90% and above. And you can see there that in and around Sydney, well, there's a couple like Woollahra where there's a bit of issue. So as you go into oranges and reds, then it's high, Rydalmere. But if you then pull out, you can start to see there in Western Sydney, the proportion of households who are actually in significant pressure is definitely aggregated in a few different areas. Blacktown there, Campbelltown, Liverpool, places like that. And in fact, if you go further out and further up, you can see how the footprint. So a lot of it's in Western Sydney, and a lot of those are in the high growth corridors. And it goes up towards North Ryde and places around there as well. So that's pretty typical of what we've been seeing in previous times, but it does really tell the story again. And if you pull out slightly further, you can see that the story is pretty obvious there. Even places like Hornsby and places right there are also on the list as well. Now, if I then go to another postcode, let's go to 3000. Okay, and so what we're doing now is starting in the centre of Melbourne and starting to pull out. And once again, you can see the patchwork. Remember, I'm showing here percentages of postcodes. So if you've got a small household count that are actually stressed, you could have a high proportion, even if the total number is not that strong. This is always a bit of a question when I show my maps, because sometimes I show it in terms of accounts, sometimes I show it in terms of percentages. But you can see there that we've got issues to the north of Melbourne, issues also to the east and towards Dandenong, and also to the west around Point Cook. So that's pretty standard. And if you go out further, you'll even see places like Ballarat also on the list as well. So not a dramatic shift, but it is interesting to continue to see these distributions in areas. And I would make the point again, as I've made before, that if you actually were to map high COVID infection rates through the last 3 months, there would be a very high correlation with high mortgage stress pools. And that's partly because people were forced almost to go to work to try and pay the mortgage. And of course, quite a lot of them were in jobs where they had to travel. So that's part of the reason. Now, if I then go across to, let's go to Brisbane. Okay, so Brisbane is not show in difficulty, but there are the odd hot spot like Albion there, 4010, getting a bit wobbly. And interestingly, as you pull out, you start to see then the similar story where there are some hotspots. And as you come away from the centre of Brisbane, you can see that it's to the south, 4106, some areas towards the coast as well, but also now Ipswich and places like that are also on the list. So again, you can see in particular areas we have these hotspot zones where there is actually quite a lot going on. And in fact, if you move down towards south of towards the Gold Coast, you can see even down there's a few interesting areas. It's not as dramatic as some others, but again, you can see some of these areas to the south and east of Brisbane where there is a bit of a problem, as well as the Ipswich area, and on it goes. And I will go over to Perth, because Perth's quite an interesting area, because everyone's been talking up Perth for a long, long time. The fact of the matter is that Perth is definitely easing back from where it was. We had a significant boom. Number of people bought, I think, right at the top of the boom, but we'll see. Sterling getting a bit wobbly. And as you pull out from the centre of Perth, you can start to see that, as normal, towards the south and towards the north, you've got a few of those hotter spots. It's not dramatic, but it is enough to just be slightly concerning. And again, I'm still seeing pockets of stress in and around Perth, particularly in some of those areas up north near Wanneroo and down south. And even places like Mandarin, places like that, are still seeing some pressures. So that gives you a bit of a flavour. I will just quickly switch my maps and go to the rental stress. Okay, and we'll just start in Sydney, because the rental stress is somewhat similar. And if you pull out from the centre of Sydney, again looking at percentage terms, you can start to see that there is actually some hotspots again. A lot of it's to do with high rise, a lot of it's to do with people who are having great difficulty paying their rents. Parramatta, North Ryde units are down more than 26% now from where they were in 2017, so it's not all uphill in terms of price growth. And some other like Northbridge, North Sydney, places like that, North Bondi and Burwood. And if you pull out further, you sort of see the geography easing in. So somewhat similar. So somewhat similar correlation to mortgage stress with rental stress, which isn't surprising. It's the same characteristics, of course, there. But I'd highlight that, in fact, the degree of stress in some of these Western Sydney areas are more significant. And if I then go to Hobart, just to complete the story, hardly similar numbers in terms of counts, but what I do see is just a little bit of activity, not a lot, a little bit that's growing around there. So it's not coming through anything like as mortgage stress is in Hobart, despite the fact that a lot of people are having great difficulty. And then if I go to South Australia, just to give you a story there. So again, not too bad, but a few pockets. And once again, you can begin to see that there are a few areas where mortgage stress and indeed rental stress is showing up. So it tells you something. If you're thinking of getting into rental properties, it's worth understanding where the rental properties are actually behaving well and where they're not. Now, I do have, of course, a lot more maps and things, including financial stress and investor stress, but I'm going to cut the map there. Okay, now just let me briefly touch on the scenarios. Now the scenarios, this is a real problem, right? There's so much moving stuff going on. So I'm still working on the scenarios, but what I'll show you what I've done so far, it's a guide, right? That's all it is. It's not saying it's completely right, but it is interesting. I've had to change the RBA baseline. So I think by 24 to 36 months later, we're going to see an RBA rate of 1.5. I think the unemployment rate will still be relatively low. Mortgage stress was going to be higher than previously. And so I've now taken down the price growth expectations from +5 to -15. So if, in fact, if the RBA is right about prices rising and the rates rise, the end of QE and all those things, that's what we could be looking at. And of course, Christopher Joy said if rates rise that amount, then we're going to see 20% falls. So interesting to see whether that's the case. 10%, my best case, this is my sort of what I think is most likely to happen. I think we're going to see a rate of about 1%. I think the unemployment rate will be about 4.8. Mortgage stress will be down from where it is, but not dramatically. There will be some losses. There is still some possibility of some growth in some areas, particularly houses, but not units. And there's a 50% chance. And then my other scenarios are if in fact we get a blow up, let's say Evergrande blows up, or let's say the financial markets finally collapse, then these other scenarios, the negative scenarios, are still there. But you can see that my main scenario now is still in this sort of area between small rises and some slides over the next 3 years. So just summarising now my conclusions, mortgage stress is an important indicator of what's going on in the economy. It's a patchwork quilt. There are some households doing very well. There are some households not doing well. I also am considerably surprised by the fact that many people who we regard as being in mortgage stress themselves know they've got issues, but don't realise the root cause of their issues. In other words, they don't understand the cash flow that they have. Only half of households actually measure their cash flow in terms of money in and money out on a regular basis. So my first observation for getting mortgage stress under control is build a cash flow. And in fact, there are some great tools on ASIC's Money Smart website, which helps with that. The second is that there is an opportunity potentially to refinance and take a lower rate, but that is less accessible to people in financially stressed situations. If you talk to lenders, they are quite picky about who they actually take. And so as we get into this situation where the people who need the help are unable to get it because the banks are less willing to refinance them, whereas the lower loan-to-value ratio and the low debt-to-income ratio loans are the ones that everyone's going after, it means we're going to see a whole bunch of households locked into rates that are probably higher with little ability to get out of them. The third point to make is that once you've made a cash flow analysis, you need to go through line by line and make some prioritization calls. So, for example, where there are expenses attached to high interest rates, for example, credit cards and credit card repayments, get rid of those first and live within your means. Whereas there are other expenses that are perhaps more likely to be ones that you want to maintain. But of course, what is priority is down to individual households. I would say, though, that things like large mobile phone bills and large numbers of subscriptions to streaming services questionably perhaps should be trimmed back. And the final point to make is that if you are in financial difficulty and you know that your cash flow is under pressure, it's really important to talk to your lender early rather than hope that it's going to improve and hope that somehow magically things will snap back. In the early 2000s, there was a snapback because incomes were growing much faster than costs of living and indeed mortgage rates. And so people were able to grow out of their financial stress. But this time around, that's not what we're seeing, because now the settings are likely to see higher interest rates, considerable pressure thanks to inflationary pressures and rising cost of living, and yet incomes probably not growing very fast for at least the next 2 to 3 years. So it is much less likely that people are going to be able to extract themselves by simply hunkering down. Much better to understand where you are and then be proactive about managing financial stress and thinking through what your options are. Be proactive, don't put your head in the sand is my advice. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.